Good morning, everyone. Thank you for joining us for this fund update with Jon Moog, the portfolio manager of the Pengana Global Small Companies Fund. My name is Adam Myers and I lead the distribution team at Pengana. To give a quick introduction to those who are less familiar with our business, at Pengana, our key aim is to offer our clients differentiated strategies that will add value to their portfolios. A number of these strategies are run out of Pengana offices around the country, or probably more accurately at the moment, run from homes around the country. But other strategies are run by international managers, and that's because if we believe that the talent and management expertise offered offshore exceeds that which is available domestically, we will seek to joint venture with those managers who will then investment manage our locally domiciled funds. Lizard investors are based in Chicago, which is a global hub for small cap investing. In 2015, we entered into a joint venture with them to manage the Global Small Companies Fund. And more recently, Pengana has acquired a majority interest in Lizard, which I think is a great confirmation of how highly we regard both the team and this particular investment segment. During the presentation, if you have any questions, please enter them in the question box on the top right-hand corner of your screen, and we'll get to as many of them as possible in the Q&A at the end. Please note the disclaimer, and Jon, over to you.
First, I just want to thank everyone. Thank you for your time and listening to today's webinar. We truly appreciate your interest in the fund. We know these are really unprecedented times and challenging times for everyone. We want to thank you for taking the time out to listen to us. And we want to start off by saying we hope everyone's family and loved ones are staying healthy and safe during this period. By way of formal introduction, as Adam mentioned, my name is Jon Moog. I'm the portfolio manager of the Pengana Global Small Companies Fund, along with David Lee, and I also serve as the CIO and portfolio manager of Lizard Investors. And today I'm gonna be talking about a few things. I'm gonna give you an overview of Lizard Investors. I'll also talk about the global small companies and what they are as an investment profile. I'll touch on our investment philosophy. I'll touch on our recent performance and what the current environment looks like, and then I'll get into some case studies or stock examples that will hopefully bring some of what we do to life. Lizard Investors, has been around since 2009. The core senior investment team have all been together since 2009 with no one has left the firm at the senior investment level. We are a specialist team focused on small cap international equities, global equities. We do that in a generalist way. So we invest in many countries around the world and really are focused on finding the highest quality businesses we can wherever they may be. As Adam mentioned, we are based here in Chicago, and it is a global hub for small cap investing, really out of the growth of some investors back 20, 30 years ago. So there is quite a culture of international investing out of Chicago. One important fact I just mentioned is we do limit our capacity in our funds because we think small is beautiful. And when you're investing in small caps, we think it's really important to maintain a limited capacity in order to drive investment performance. And our goal here is to drive investment performance and not drive AUM of the vehicles, which is similar to many of the Pengana products. Here's a slide and a picture of the team. I think importantly, both myself and David Lee joined Lizard in 2008. We've been working together for well over 10 years now. And have formed a great bond and partnership and culture here at Lizard in attacking the global small company space. Lee Azell is the founder of the business and has been investing in this space for over 25 years and really the one who got us together. We have grown the team over the last 5 years. Mickey Ryan was the first analyst we hired back in 2015. And then we had 2 more additions, both Kevin McCory and Tam Fan. And so we've slowly been building the team over time as our culture really took hold, our investment process really stuck in place, and we wanted to add capabilities to really drive the diligence process for investing. So that's the team as it exists today, and we've only had 1 analyst leave us since the inception of the firm. Moving on to the global small companies as an asset class and an investment opportunity. This is a space we're really excited about. Obviously, this is where we spend our careers, and I want to talk to you guys a little bit about why we think it's such an exciting place to invest. When looking at this space, it can be a bit overwhelming. There are over 50,000 global small companies that one could invest in. The universe is obviously massive, but also very inefficient. Many of these companies are underfollowed and underowned by institutional investors. This creates not only a great opportunity for inefficiency, an opportunity that we want to attack and really have built Lizard to attack, but it also creates a challenge of having to find these companies and invest in them. And we think really what we've designed at Lizard from an investment process is unique in being able to attack that opportunity set. But we think it's absolutely a fantastic place for active managers to be, given the inefficiencies in the space. Historically, the space is small caps have outperformed large caps, and I think that over a long period of time, there's a lot of academic studies that would prove that out, and something that we think is a tailwind over a full investment cycle. And we also think one thing that's pretty unique about us is the portfolio is very difficult to replicate. Our portfolio, I hope as many of you look through it, will have many names that you're not familiar with, and many companies that not many institutional investors own. And I think that's one of the real advantages to investing in this space. So just to touch on again, kind of the drivers, Fama French is a famous academic model and study. Eugene Fama is a professor at University of Chicago, which I attended, and actually took a class with him back 15 years ago or so. But he did a very detailed study and really boiled down to excess returns in the market driven by three factors. The first being beta, which is just exposure to the market. The second really persistent driver of returns is being exposed to small caps. And the third is being exposed to value investing. And I think that is exactly what we deliver here with the Pengana Global Small Companies Fund. We are a small cap, value-oriented fund, long only, which gives you the beta. So we are really geared to deliver where there is the most persistent excess returns in the market over time. And here's a slide that would show you since December '99 exactly how much excess return you would earn. Here it shows small caps outperforming large caps by over 300 basis points a year. And if you compound that over a 20-year period, that's a pretty extreme outperformance, and something that we think most investors would benefit from and should get pretty excited by. But we think it's important to make sure you are with an active manager in this space. Obviously, the world of passive has been growing dramatically as large cap strategies have gotten too big, and really is a challenge to outperform in large caps. That is not true in small caps. Small caps, we think, is really the last bastion of alpha generation for active managers. And there's some pretty persistent reasons for that make indexes really tough to make it challenging for indexes to replicate our space. The first is a huge chunk of small caps are either uncovered or covered by very few analysts. And here you can see that with only 5, if you look at your average large cap, 22 analysts cover each company. If you look at small caps, the average number of analysts covering it are only 5 analysts. That being said, a huge percentage of the small cap universe is actually uncovered. That means there's just a much higher likelihood that traditional fundamental research will be able to produce a unique investment opportunity and be able to understand it that creates a meaningful, lasting, durable advantage that we think doesn't really exist in the large cap universe anymore. So that's really what gets us excited, what revs our motors, and why we think active management in our space is so powerful. And I think what's unique about us coming to Australia, I think there's been a large culture of investing in global small caps here in the US for a long period of time. That hasn't been as true in Australia, where there is a much larger domestic company bias that we've seen over time, especially in the small cap space. And this shows, this chart just simply shows there are only six funds that are rated investment grade by Lonsec, you know, in our space. So it is a challenging space to operate in, and that's why we think there's just not that many competitors geared to really digging out the alpha, which we think is really our opportunity, right? The less investors in our space, the greater the opportunity is for us. Next, I want to touch on our investment philosophy, how we really attack what we think is a unique space and how we deal with it. And so really our philosophy is buying a portfolio of high quality businesses will deliver very good returns over a long period of time and also be the best way to preserve capital, also from a long-term perspective. So we believe buying very good businesses and filling a portfolio up with very good businesses will not only drive the best returns, but also preserve capital. Well, the best way to preserve capital in drawdowns and challenging periods like the one we just experienced in COVID. And let me talk for a minute about how we think about high quality franchises and businesses and why we think that is the case. We define high quality businesses as businesses that earn high returns on capital over long periods of time. Generally, these businesses should have very big competitive advantages that will allow for those persistently high returns. The second thing we look for in a high quality business is a very good balance sheet. So we want businesses that can fund themselves through almost any market cycle. And the third thing we really look for is a management team that is aligned with us. One of the beautiful parts about investing in small caps is you can invest in businesses where founders have meaningful stakes in the business and are very aligned with driving value and protecting capital. So we think the combination of those three things, making a high quality business, combining with a very strict valuation discipline, allow us to put together a portfolio of businesses that will create value over time. And in downturns, in economic downturns, also those businesses are the businesses that can go improve their competitive position dramatically and come out of the cycle much stronger. You know, and that is really our core philosophy. And I think one of the questions we get often, and one of the things that I talked about that universe of 50,000 names, you know, how do we go out and find these businesses? How do we do diligence on these businesses? I think this is where it's important to understand the team has been doing this now for 12 years. We are firm believers that there is no substitute for talking and meeting with management teams. We have met with thousands of management teams since inception. I'd hazard to guess 3,000 to 4,000 management teams since inception. We have over 400 interactions with management teams a year. We really believe the best way to get to know these companies is to sit down and talk with them and really understand their business in a deep way. And one of the really great parts about investing in small caps is we can get access to CEOs, CFOs that really can, in a detailed way, explain their business to us. And we think that's really where there's a lack of understanding in the market. And we think that's a really critical piece of our process. And that institutional knowledge that we've built up over 10 years, is really tough to replicate, and really one of the core drivers of what we think our edge in this space is. You know, the other point I would make just before leaving the slide is we think delivering the returns in this small cap strategy, it's important to deliver you a reasonably concentrated portfolio. You know, typically for us, our top 10 names make up 30 to 40% of the portfolio. So it's a high conviction portfolio. While you will be exposed to the beta in this space, it's also important to understand to really get that alpha generation, you need to be concentrated into your best ideas, which we think is the best way to deliver returns in our space. And moving into portfolio construction, which I just touched on briefly, but want to just highlight a little more. What does the portfolio look like? The portfolio is diverse from a geographic and sector basis. You will never see us take large sector bets or geographic bets. We want diversified views there. We were reasonably concentrated. So again, kind of 30 to 50 positions. Position sizes ranging from 2 to 5%. And top 10 will typically make up 35 to 40% of the portfolio. This portfolio is intended to be run with it fully invested. You know, you will see us have cash as an option. You know, we can run cash up to 20% of the portfolio, but typically it will only be 5% of the portfolio. And really, we just hold some excess cash, given that we are operating in a small cap universe. And we want to make sure during drawdowns, as we just have had in COVID, we can be actively buying those companies we want to invest in without having to worry about what we want to sell. The investment horizon for us is 2 to 5 years. Again, we really want these businesses that will create value over time in the portfolio, and we want those businesses driving the value of the portfolio. And that's something we feel very strongly about. And I think you would see that in our turnover. And we would define target median market cap as under 3 billion. So under 3 billion is the global definition of small cap. We have historically run between 1 and 1.5 billion as our median market cap. So how is the fund performed, and what exactly are we doing in the current environment, and how we position the portfolio? I want to spend a few minutes talking about those things. The fund performance since inception, you know, we have been in line with the benchmark since inception. You know, and I would like to talk a little bit about why the performance hasn't exceeded the benchmark. Which we believe over a long period of time we are well positioned to exceed the benchmark. So I just want to talk a couple minutes about what the headwinds have been for our benchmark, which is the ACWI Small Company World Index. This slide, while optically a little confusing, is actually very simple. What the bar charts, what the bars recommend, and I'll try to just highlight those with the cursor right now. What those bars really indicate are decile of market size. So first decile is the largest companies. No, the 10th decile is the smallest companies. So you can see, based on this bar chart, the weighting of our portfolio versus the index. We are largely weighted towards small caps versus the index, which is much more weighted towards the first decile, which are larger cap businesses. So we are very much overweight small caps in our portfolio. But you can see what the dotted lines really indicate performance in each decile. So each market cap, how is our stock picking, frankly, compared to the index? And the persistent green line above the index line, which is the tan line, indicates that we are adding value, or we are picking stocks that outperform the index in almost every size, besides, I guess, the 8th decile. But over time, we've picked stocks that outperform the index. However, we are quite underweight large caps. And really what's happened over the last 3 to 4 years, as many of you know, large caps have outperformed small caps, which is very, on a long-term basis, small caps outperform, but in the last 3 to 5 years, you've seen large caps dramatically outperform small caps. So we think we are poised very well for reversion of the mean when small caps begin to outperform large caps again. We think the fund is very well positioned to capture that. You know, and the other point I would like to make is our performance against our peers, which have been suffering some of these same headwinds. Here you can see we've consistently outperformed our peers since inception of the fund. We've outperformed by almost 300 basis points a year, and that's been fairly consistent across most time periods. So again, we think we're delivering a lot of value on the stock picking side. We believe we are delivering value ahead of what our peers deliver. And frankly, we feel we're very well positioned for a reversion to mean, which I want to spend a few more minutes discussing after I talk about the current environment. So what does the current environment look like? We've all lived through it. It's been an absolutely, I think for almost any investor, whether you're on you're a financial advisor dealing with asset classes, or you're a fund manager like myself picking stocks, it has been a very unique time period. I think, I've been doing this since the year 2000, and I've lived through the 2001 downturn, 2008 downturn. Every downturn is unique, but the pace of this one has really exceeded anything most investors in their career have seen. So we've had obviously everyone's aware of COVID. And I think one of the important takeaways is the range of outcomes here is still very wide. So people have to be very, very eyes open and mentally flexible in terms of the economic outcomes here. We've had a very large surge in unemployment globally. I think you're seeing that in the US. you've never had unemployment spike this fast around the world, and I don't think we know what the outcomes of that are. We've had government intervention and both fiscal and monetary stimulus in really an unprecedented way, both in the U.S. and in Europe. I know the U.S. is throwing around some massive numbers, but you've seen companies like Japan and Germany actually stimulate even more than the U.S. on a per capita basis. We would expect interest rates to stay low for a very, very extended period of time. And obviously demand in a lot of sectors has fallen off a cliff. You know, and I think the pace at which that returns is still very much in question. And then the last piece is really you've seen this, you know, passive funds have been growing as a percentage of the market, quant funds have been growing as a percentage of the market, and they are effectively generally momentum-driven products. And so the frenetic trading by these funds has really exacerbated the market volatility, and I think something most investors should be prepared to continue given the size of these funds. You know, and just as an example, you know, this was the fastest sell-off we've had since the Great Depression, and also included the largest three-day rally we've had since the Great Depression, which is pretty staggering when you think about both of those things happening in the same quarter and the context of it being the Great Depression. So how have we navigated this environment? How is the team really, what has been the rallying cry for our team during this period? And really, you know, when David and I sat down with the team and talked about what we wanted to accomplish, we had two core goals. One is to preserve capital in the short term, and the second is to acquire really high quality businesses and upgrade the quality of our portfolio so they could drive returns over for the next 3 to 5 years. And so how do we do that? How do we think about that? We dramatically increased the amount of interactions we've had with management teams. If you remember earlier in the presentation, I talked about having about 400 interactions with management teams a year. That would typically be 30 to 40 meetings a month. We had 178 calls. Unfortunately, it had to be calls, but calls in the back half of February and in March alone with management teams. So we were hyper aware of what was happening in the market. This allowed us to move quickly and capitalize on repositioning the portfolio, both to get out of positions where we thought there was a much larger issue that we had to move to the side, but also really positioning the portfolio into those companies that we think can drive returns for the next 3 to 5 years. And I'm very proud about how the team has handled it, and very proud about how we position the portfolio and how we think it's going to perform going forward. You know, where do we stand today from a market environment perspective? And I think just giving some, you know, this is just to give some color on how we're thinking about things. You know, the market has recovered meaningfully from the lows. We are now getting through Q1 earnings, and, you know, you have some issues developing in Q1 earnings, but Q2 earnings are really where you're going to see huge, you know, these huge, massive issues arise, right? That's really the period from April through June. So that's something we're preparing for, and we think that's, you know, we think it could take years for earnings in many sectors to recover to their prior peak. So, you know, we're looking at kind of a 3-year map back to peak earnings. We think there's a huge disparity in opportunities out there. We think there's still a lot of really good investment opportunities on the long side, but we think there is also a lot of minefields that investors need to be very careful not to step into. So we think that's a fantastic environment for active managers to be in, but we think you also need to be careful because there is going to be some more pain out there. And back to that point about high quality businesses, we think it's more important than ever to be invested in very good businesses that will improve their competitive position through this downturn, and that have the balance sheet and the management teams that can take advantage of what could be persistent weakness in the economy. You know, I talked about that demand longer term. I talked about the demand destruction, and it may be a little bit more persistent than some investors are currently expecting. Of course, we think the outcomes are wide, and we'll have to see how that plays out. We also don't know how all this monetary stimulus is going to impact currencies, is going to impact economies, and that's something we're keeping an eye on. And the last piece is really, we expect mean reversion in the small cap space over time, and we think that is a very powerful tool, very powerful producer of returns, potential returns for us. And so let me just talk to you guys a little bit more about why I think this is so important. here at Lizard, you know, our fund would be typically much more exposed to global companies outside the U.S. than the index would be. The index would typically be 50% U.S. small caps and 50% rest of world. We would typically be 25% U.S., 75% rest of world. We believe that diversification is actually very good for investors. What has happened is obviously the U.S. has outperformed really dramatically the last 5 years. There are many investors out there right now who believe that's a very persistent thing, and the U.S. will always be the best investment destination for capital. This chart, I think, is really important to understand where we sit in that U.S. versus non-U.S. debate. This is a rolling 10-year return chart showing returns, and when you're above that dotted line in the green, that means international is outperformed. And when you're in that blue space below, that means U.S. is outperforming. We are well below the mean in terms of U.S. outperformance. That means, you know, we think we are well positioned, and I think if you look at any valuation tools out there, would also indicate that international is really poised to outperform the U.S. For an extended period of time as things mean revert. And so we think that's really important to understand about our fund, and also about the context of the universe we invest in, is that international is very much, you know, outside the U.S. is very much out of favor, while the U.S. is very much in favor. And we think for most value investors, you know, this is, mean reversion is a very powerful tool, and one we think we can take advantage of over the coming 3 to 5 years. The second piece of this mean reversion I just want to touch on is small caps over a long period of time outperform large caps. I don't think there's any doubt about that. But this chart shows those periods in which small caps lag their larger peers versus they outperform their larger peers. And you can see where we are today. We are at really near a low point of small caps underperforming. And I think, you know, it's really important to remember the quarter we just went through, the carnage in the small cap space was much more extreme than what we saw in the large cap space. You know, when we were looking at the indexes, the top decile of market cap in our space, I think outperformed the bottom decile by 20% in that Q1. So top decile was down 19% in Q1. That bottom decile was down almost 40% in Q1. So that disparity is massive. We think that sets up well for small caps in the rebound. In a rebound in the market, small caps will outperform pretty dramatically as you see that mean revert and small caps begin to outperform again. So typically during drawdowns, you will see small caps underperform, but that comes back with a vengeance as small caps start to outperform. And so we think right now is a great time to be looking at our space, because small caps have underperformed, even though they tend to outperform pretty dramatically over time. Now I just want to get into some stock stories and some case studies about businesses we're excited about, why we're excited about them, and hopefully it gives you a little more flavor of how we think about investing and how we think about businesses. The first company I'm going to talk about is Boohoo, and if any of you have been following us since we brought the fund to Australia, you'll know this is a name we've been talking about since 2015. And we haven't talked about it in a while, but I wanted to talk about it here today because I think it's pretty interesting. Boohoo is a business that does online apparel retail, mostly in the UK and Europe. They've moved into the US over time. They've got some really powerful brands, the Boohoo brand being the largest, but they also have a brand called Pretty Little Things. And their customer base is largely younger women, and they would effectively be an online competitor to the likes of H&M or Inditex. So fast fashion in the retail space. Now, we first came across this business as a broken IPO in 2015. We had the chance to meet with management who is very aligned in the business, owns a very big chunk of the company, and have really been the drivers of this business over time. What we were really impressed by after we met this business was they have created a very unique low-cost position in their space, given their supply chain. They're much more nimble than their physical retail competitors, and they can generate higher returns than their physical retail competitors, given their working capital requirements. So really a powerful model that generates high returns, but also grows really rapidly. And so why we're flagging this today and why we actually purchased more shares here fairly recently is this business, what we are seeing happening in the market is this COVID crisis, I'll call it a COVID crisis, is actually really accelerating some of the changes we've been seeing structurally in the economy. You know, so if you want to think about businesses, you know, retail shopping, online versus offline, we are seeing acceleration in online shopping. We're seeing an acceleration in those businesses where working from home are driven by working from home, and we'd expect to see office space struggle over time. Corporate travel versus video conference, all those things are really accelerating right now, and we think many of those changes will we have seen these before. When you have these massive downturns, those changes accelerate, but they don't revert as much. So we would expect, you know, Boohoo and Amazon or whoever, all these online businesses, to capture share during this downturn and keep it coming out of it as well. So I think that's an important point to make, and that's something to think about, is really, you know, this crisis will create some acceleration and structural changes in the economies that we have been seeing for a while. And I think Boohoo is a great example of that. And at the trough, and when we bought this company and, you know, bought more of this stock in March, we were buying this company at 25 times earnings, which sounds expensive until you look at it and realize this business is growing at 40% a year. You know, we have first invested in this business at 250 million market cap. You know, it is a much bigger company now. Still a small cap, but a much bigger company now. And they continue to pound out 40 to 50% growth a year. You know, they're almost a 4 billion pound company now, but they continue to grow 40% a year. So when you compare 40% a year growth with very high returns versus a 25 times PE, that's very attractive to us. And we think the market was giving a, you know, plus the structural shift that will be accelerated in COVID was very attractive to us. So those are the types of situations we're getting excited about and we're looking for. And I think something everyone should be thinking about is what sectors are going to be really left behind here, and what sectors will actually be long-term beneficiaries from some of the things we're dealing with today. The next company I want to talk about is just before moving on, you know, right now Boohoo represents about 4% of our portfolio, so it is important to us. The next name I want to talk about is Avast. It's a newer investment for us. We're currently, you know, despite all these green dots, we've actually made about 20% on our average cost through today. But Avast is a business we thought interesting to highlight, and what happened during the crisis and why we were buying so aggressively some of these businesses during the crisis is Avast is a business we've been following for a while. They operate, they've created a leadership position in the virus protection market. So for personal computers, so they are, you know, they have over 450 million customers. And they operate a freemium model. So if you bought a computer and you wanted virus protection, you could theoretically go to Avast and get free virus protection. And then over time, they upsell you into the premium virus protection as well as VPN. And so it's actually created a very recurring, growing business over time. And with 450 users, 450 million users, it's really, I mean, when you think of that, or 435 million users, on a global scale, they have massive reach into many customers, more than almost any other business we know. And so really a unique model, and a model that has really grown organically for the last 20 years with the same management team and same strategy. This is a business that we think will continue to grow their customer base as well as their penetration of their customer base. The company had some negative headlines during the COVID crisis, and frankly, it was just a time of investor panic. Here you can see, you know, from a, you know, the stock chart, the stock was down over 50% during the crisis, and really with on some news that was irrelevant to the long-term value of the business. And we ended up buying our largest chunk of this company at low, you know, 10, 11 times cash earnings for a business that grows 10 to 15% a year with, again, very high returns, very good balance sheet. And when you think about this business during a crisis, actually may benefit as more people need VPN, more people will be working off their personal computers, a business that actually will not see any big deterioration in earnings, and another opportunity that we think is both was great in the crisis, but will continue to drive the portfolio going forward. Another interesting name I wanted to highlight, and some of these structural changes we talk about here, is a business called Kindred. Kindred is one of two companies that we've invested in the online gaming / gambling space. Kindred is an operator, so they operate a online sports gambling and as well as casino business. The business is, we've known the business since 2010 when it was a business when the business was actually called Unibet. It's listed in the UK, but largely a Swedish business, which many of the Swedish were actually very early adopters of online gaming, and many of the leading technologies that come out of there. In fact, our other investment in the space is also a Swedish business. Kindred represents about 2.5% of the portfolio today. We have always loved the management team. We think they've done a great job, and recently they've been buying the stock very aggressively. So why are we interested in this today, and what's the opportunities that we've seen? This stock has had a very challenging 2 years. A couple of things have happened, but most importantly, there was a re-regulation in the Swedish market, which had an impact on earnings in 2019, and should impact earnings, and should be continuing to impact earnings a little bit in 2020. So you've had massive earnings revisions in a negative way, in what we believe to be a temporary issue. But where we get excited is we've always seen as these markets regulate, the business comes back much stronger, and those high quality businesses that Kindred is really one of the best in class operators who operate well in a regulated environment really can take advantage of this, of these changes. So we think this is a structurally growing business in Europe. We were buying this business at single-digit earnings multiples, very cash generative, very little debt. And the other piece that I just want to touch on, and I think something that is very exciting for a lot of these businesses, is that the fact that the U.S. is now opening up state by state to online gaming. And I think one thing that many investors are not appreciating quite fully yet is that the opportunity set in the U.S., if you look at the U.S. market size from a gray market or black market perspective, will be quite a bit larger than what we've experienced in Europe. So European players have had building their technology for 20 years, are way ahead of their U.S. competitors, and U.S. is now opening up, and Kindred is an example of a business that's gotten licenses in the U.S. And we think there is potentially explosive growth in the U.S. market for many of these businesses that creates fantastic optionality for us. And here we have a management team that knows how to take advantage of it, along with a balance sheet that allows them to invest in the business, and is also out of favor for what we think are temporary reasons. So Kindred is another business we're very excited about. It represents about 2.5% of the portfolio today. I mentioned that other gaming business is a slightly smaller position, but between those two positions, we have about 4% of the portfolio exposed to the space. The last business I wanted to touch on is Swedish Match. Swedish Match is a tobacco business, and I know shockingly that the name is based in Sweden. The business, they are a leader in snus and other types of smokeless tobacco. So think about that as tobacco you put in your mouth. You know, they do it quite nicely. Snus is a packaged version of chewing tobacco, but it's the type of tobacco you chew in your mouth. This is a business over the last 20 years, the management has executed flawlessly. They've grown earnings at close to double-digit pace with very high returns, you know, and just a very good business with quite a bit of pricing power. The stock was under pressure when we first started accumulating in 2019 due to some issues with a piece of their business, which has to do with cigars in the U.S., which we don't think is that relevant to the value of the business. But as we started looking into this business, what got us extremely excited about this investment was the addition of a product called, which they're rolling out in the U.S. called ZYN. And ZYN is a tobacco-free, spit-free form of nicotine. The way to think about it, it's similar to, you know, conceptually it's similar to nicotine gum, but you can think about it as almost like chewing tobacco form of nicotine gum. And what we have learned and why we have been so excited about this investment and continue to be is that when we initially bought this product, our vision was, and I think the company's vision was that this product would take share from chewing tobacco in the US over time, which is a big market and a big opportunity. But what has happened recently, as some of the vaping, nicotine vaping pens and other types of products have really come under pressure for health reasons, what we are seeing is the adoption of ZYN as a healthy alternative to this, which is a much larger market. And so we continue to see ZYN as potentially a very big growth opportunity for this business. So to put it in perspective, this is a tobacco business that's been around for a long time. Last quarter, this business grew top line 24% and operating profits by 34%. There's no other tobacco company in the world that is giving you that kind of growth. And this is a business that even after its appreciation is only trading at 25 times earnings. And just to give you a flavor of how fast ZYN is growing, ZYN in the first quarter grew 300% year over year in the US. So massive growth. We're seeing massive adoption in the product and something we continue to be very excited about. This is our second largest position in the fund. It continues to be our second largest position in the fund and is almost 5% of our capital. And we think continues to offer a very attractive risk reward. So those are some businesses I wanted to walk everyone through, businesses that we continue to be excited about. Hopefully that gives you brings to life a little bit what we do and what we talked about. But I think as I wrap this up and we move into questions, I just want to really finish by, first of all, thanking everyone for their time and listening to us talk about what we do. We're very passionate about our space. And frankly, we think the opportunity set today, given the fact that small caps are out of favor, given the fact that international is out of favor relative to the US, are really very attractive. So we hope you've enjoyed the presentation, but also really take away the unique opportunity we have both in the space and within our portfolio of owning some very high quality businesses that we think can deliver returns for a long period of time for our investors. With that, I'm going to probably bring Adam back and hopefully turn it over to some questions from all of you.
Thank you very much, John. That was great. A number of questions have come in, and I'll get straight on to them. In this crisis, how did small caps perform relative to larger caps, and what are the implications for small caps on that basis coming out of the crisis?
Great. Thank you for the question. I think I touched on it before, but I guess just to hammer the point home, we really saw small caps dramatically underperform large caps. That has been a global phenomenon. You've seen it in Europe, you've seen it in Asia, and you've seen it here in the US. Large caps, given some fund flows, have hung in there. Performance has been down, mid-teens or whatever it might be, but you really see small caps dramatically underperform their large cap peers. We think that sets the table for small caps outperforming out of the crisis pretty dramatically. So we think the opportunity set in small caps combined with the valuations you're seeing in small caps really lead us to believe, we think on a 3 to 5 year basis, that small caps could significantly outperform large caps.
Thank you, John. The next question is, has COVID exposed any weaknesses in the portfolio, and what lessons have you learned, and what will you be doing differently going forward?
Yeah, I think that's a good question. I think throughout a crisis, you can always count on being humbled in certain ways. And I think, a good example for us, so Wizz Air, and here is our top 5 contributors and top 5 detractors over the last 3 months. But Wizz Air is a name, we've talked to everyone about for an extended period of time. It's a business we think very highly of. But we do believe some of these changes that we're seeing in the marketplace could be quite structural. And one of the areas we're very focused on trying to avoid are those situations where there could be very persistent oversupply in the industry. And you need reasonably large capacity reduction to actually make sure the industry gets back to a normal supply-demand balance. And I think airlines is one space we think that may need to right size, and it may be quite a painful process to get to that more normal demand supply balance. And so, I think one thing we did well in this crisis, and is really make sure and look at each name, despite our historical knowledge of the name and our opinion of the name, and try to be aggressive about making sure we are getting out of some of those places that I talked about before that might have these structural problems that I've been talking about. And I think Wizz is a good example of an airline. So really, it was about going name by name through the portfolio and making sure we felt very strongly about the business and the business model coming out of it, given that some of, this is quite a unique crisis. It looks very different in my opinion than '08, in that you're just seeing demand in certain segments of the economy just go away. And I don't think that's something any of us have ever lived through. So we want to make sure the portfolio is not too exposed to those. And so I think it's a long-winded way of answering that question, but I think we tried to move aggressively to get out of the way where we think the uncertainty is just too great right now.
Thanks, John. I guess linked to that question somewhat, you spoke about Boohoo and your expectation that there will be long-term beneficiaries from the crisis. What are the other sectors that you are most excited about coming out of this downturn?
I think we continue to believe, I think one thing we've been talking a lot about is, I think there's going to be some short-term pain in company budgets, but I think this, IT security will continue to have to be a massive investment for companies as they start to try to figure out how to really secure their networks in a lot of these in a lot more open environment, so to speak. So that's a place we've been spending time thinking about. David's been spending a lot of time looking at security software businesses. Online retail is an obvious advantage, that I've talked about. In my view, I think a lot of the spaces that consumer staples, all those things, I think will continue to be great places to be. But ultimately, I think more importantly are what areas are we trying to avoid, and it's really where we think there's going to be a pretty persistent demand problem. So we can get excited about a lot of places. There'll be a few beneficiaries, right? This is a nasty economic downturn, so obviously the pain will outweigh the beneficiaries. But from our point of view, really avoiding the places where there's going to be pretty persistent pain is going to be important to delivering returns going forward.
Great, thanks, John. The next question is, how would you describe the riskiness of this strategy relative to the benchmark, and particularly to the broad cap index as well?
In broad cap, meaning larger cap index?
I'm guessing that's what the question implied.
Yeah. So, I think our portfolio over time versus our index has tended to be slightly lower beta with smaller drawdowns than the index. Unfortunately, the stats aren't in the presentation, but we tend to be a little less risky than our underlying benchmark. I would expect our, over time, the standard deviation of the small cap space is a little bit larger than the large cap space. But obviously the return profiles you get from that are quite a bit greater. So, in any given period of time, I would say small caps are a little bit riskier than large caps if you're worried about short-term drawdowns. That being said, I think putting it in context of where we sit today, having lived through small caps underperforming the broader market, so to speak, I think you've had a situation where small caps have really been de-risked. And so you're in a situation where, my opinion is small caps are actually at this point quite a bit less risky than large caps, especially if you start looking at valuation multiples of large caps versus small caps. My belief would be you can get a more attractive return profile as well as lower risk.
Great, thanks, John. Next question, despite the current environment, PEs, particularly in the US, still seem unreasonably high. How does this compare in small caps?
So what you would find is US large caps, PEs are still pretty excessive. We would definitely agree with that viewpoint. If you look at the small caps, they are slightly cheaper than large caps. That being said, US small caps are still quite a bit more expensive than small caps around the world. It's a phenomenon that concerns us, and why you see our weighting so much tilted towards non-US compared to the benchmark. So I think that's a viewpoint we'd agree with, that US is generally fairly expensive. And I think, we've highlighted what we think will be an opportunity for mean reversion and really driving returns through the international side going forward.
Thank you. Combining two questions here, what do you think the chances are of market lows being retested as second rounds of COVID hit countries? And secondly, how are you thinking about your portfolio positioning if lows are retested?
I think that's actually a really good question. We are long-term investors, but I think it is important to think about what the market's done in the last quarter. And where we sit is we do believe anyone's best guess, but to retest lows, we think would be a challenge. There's been so much stimulus out there, and that's a broad market commentary. We do think there are going to be sectors and companies that will look much worse in 6 months, and those could absolutely blow through their lows. But as a broader market, we would not be surprised to see another sell-off in any way. And I think, we are positioning the portfolio to make sure it can withstand a sell-off and are becoming a little more defensive than we were a month and a half ago. That being said, I think retesting the lows is probably, I'm not sure we're going to see a retest of the lows. However, I would not, we are positioning our portfolio a little more defensively. I wouldn't be surprised to see another wave of sell-off here, especially as you get into Q2 earnings, which we think are going to look look quite bad. Again, you're not seeing a lot out of company forecasts. So our view is you could absolutely have another sell-off. How extreme it gets, we doubt it'll retest the lows, but that's our view right now.
Thank you. Quick question: do you employ stop losses?
We don't employ a firm stop loss. I think what we've learned empirically over time is a stock price that goes down a lot after we bought it would indicate that our thesis is wrong. So we absolutely examine each position. We typically use 20% as a threshold of really re-examining the position and deciding whether we want to re-underwrite the security or not. But we don't have firm stop losses. And I think, there's some common sense elements to that in that, if the environment's fine, stock's down substantially, generally that's going to be company specific. If we would have employed stop losses in Q1, we would have had to sell every company we invested in, right? Because all these businesses were down 20 to 30% or more. So for a period of time. So we don't employ stop losses, but we are very aware of stock price movements and what it indicates about our thesis versus what the market is telling us. And that's something we always seek to understand. I think empirically we've learned over time that we need to be pretty aware when we're wrong about a stock for a long period of time. We move on. But we are patient investors, but so I think it's a common sense approach, but we don't have a firm stop loss.
Great, thanks, Jon. And this last question I'm going to ask feels like you could devote a whole hour to it, but in the interest of time, maybe you can just touch on a few highlights. With a universe of around 50,000 stocks to choose from, how do you decide what to look at?
I think that's probably the most frequent question we get. And if I were to describe our process, rather than, I think what you see a lot of investors do is use quantitative filtering mechanisms to try to get to a manageable list of securities to look at. We actually have done it a bit differently. And again, I referred to those thousands of businesses we've met with over time. What we've really tried to do is go out and read about those businesses that we think are interesting, meet with the management teams of those businesses that we think are interested, and over time really build up a institutional knowledge of businesses that we think are high quality business, high enough quality for us to invest in, which is probably about 10% of the businesses we look at. So a very few percentage of the businesses we look at meet our quality criteria. And what we've really done is built up over the last 12 years a list of those businesses that we want to invest in. And I think at this point, David and I have been able to really hone in on those types of business models we want to look at, we want to invest in. And so we really focus on finding those rather than worrying about being everywhere in the whole 50,000. It's really about building knowledge in those companies we think are very exciting, that can drive value for our portfolio, can drive value over time, and then we're patient about acquiring them. And for us, we were very attractive in the first quarter because we have that institutional knowledge. And we were able to go buy a lot of those companies that we've been hoping to buy for quite a period of time. So that's really how we approach it. We think it's very hard to be everywhere all the time. We don't try to do that. What we want is a diversified portfolio from a sector and geographic basis. And we really want those high quality businesses that we find to drive the performance over time. So that's how we approach it. And we think it's been very effective for us in our space.
Thanks, John. I think that was very comprehensive in the context of the time I gave you. I think that I'm going to wrap up the Q&A now in the interests of time. If we didn't get to your question, we will respond directly to you. Thank you very much for joining us for this update today. I hope you found it useful, and if you had any concerns, I hope that some of them have been addressed. My key takeaways are probably first that the team are clearly good stock pickers. As we saw, they've outperformed the index across virtually all deciles. And secondly, how compelling the current opportunity to invest in small caps at the moment is. Our next webinar in the series is next Thursday, the 14th, with Fred Pollock, who manages our private equity trust. For those of you who haven't registered, I urge you to do so at pengana.com/webinar. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much.